Hi, this is Daniel Walsh from the Anchored in Property podcast, and today we're going to be doing a Q&A session from all the questions that have been coming in from Instagram. Firstly, though, we're going to get into thought of the week. So, thought of the week would be the strategy means more than the timing of buying property, right? And why I mean that is because when you're buying property, it doesn't it's everyone's time horizon is different, so therefore the time on which they should be buying a property changes. So for example, somebody could say to you, I don't think it's a really good time to buy a property. But then the question really should be, well, what is the strategy behind it, and why do you want to buy a property, and when do you want to exit that property, or do you want to exit that property? Because if I turn around and say it's not the right time to buy a property, and then I say, well, I want to flip it in 12 months, you may be correct that it might not be the best time to buy a property. However, if you said, I want to buy a property, and what I want to do is it to go towards my long-term goals, which is paying off my own home, and I'm going to need to acquire three, four, or five of these properties so that over 10 years, I can then look to sell down the properties to pay off my own or occupied property. And instead of doing it in 30 years, I might do it in 10 or 15 years. Then all of a sudden, when somebody says you shouldn't be buying a property right now because maybe it's not the best opportunity to buy, it actually may now turn out to be the best opportunity to buy because it fits your strategy. So, what you're trying to do is say, does buying a property today fit the strategy for me? Right. So, everyone is a little bit different with that. Some people, you will say, yes, it does fit right now. And other people will say, no, it doesn't. And that depends on strategy, time horizon, right? Anyway, that's thought of the week. It's time to get into some questions. Now, number one question is, what other structures do you use once you've exhausted your personal lending? I mean, I think this is the key thing when it comes to building a property portfolio. The banks are there to protect you from being stupid with lending. And I understand that everyone wants to push the barrier and they want to go as far as possible. However, when things do go, south, are you safe in what you're doing? And the banks are there to basically say, hey, I'm going to make sure that you're not going to trip on yourself when things go bad because we've already put buffers and measures in place for you, right? And if you're not a sophisticated investor and haven't been doing this for decades, maybe that's really what you need. You need to push your portfolio as far as you can without going so far that you are getting into the realm of debt that you cannot get out of if things go south. And I'm probably one of the rare property guys that says that, because everyone just says get into as much debt as possible. And I agree. However, you've got to know what you're doing when you're doing it. So the banks are there to protect you. Now, how I would do it, right, is firstly I get a really good broker, and I would want to understand with that broker what my finance strategy looks like 3 or 4 properties from now. What does my personal capacity look like? I want to understand as well, not just the personal capacity, but what am I going to output in terms of income over the next 1, 2 to 5 years? Because as I'm building out my finance strategy with my broker, I want to also be letting him know what I'm thinking from my career. What do I believe I'm going to earn in 3 to 5 years? Because that's going to play into the strategy of how many properties go into your personal name, and then how many properties we need to, switch it up into company structures or trust structures. Now, it depends as well how hard you're leveraging, and it depends on the situation. So I've had clients that have come to me and they've had, five, six, $700,000 in cash, and they're saying, well, should I be buying in personal names? I'm like, well, you're not going to get that cash back very easily. So therefore, it's probably best to go seek out advice around trust structures and company structures, because we could put those put that cash to work with larger deposits so that we can get those entities excluded in the future. And then once we've excluded those entities and we've started to exhaust our borrowing capacity, because we don't have as much cash to put into entities to get those entities positively cash flow, at that point, then we start to go back into personal names and start to max ourselves out in personal names so that we can offset our income in the future. Even though negative gearing is gone, it's not gone for when you sell the property. So if you're looking to buy a property and that property is going to ultimately help you pay off your own home, well, then what we could do is buy a few properties in those trust structures or company structures. However, once we start to run out of cash, when we get into higher equity leverage and we're buying more properties on leverage, at that point, we then transfer back into our personal names and we start to max out the personal side. So it depends on the structure. It depends on how much money you come in with. Are you coming in with cash or are you coming in with equity? If you're coming in with equity, probably won't do it that way. You'll probably go personal names, maximize the negative gearing on the sales side of things so that you can, capture all of those losses against your own income and you can reduce your capital gains tax quite significantly for doing that. You still could go into maybe a trust structure as well. You'd have to explore that. Now, you're not going to, you generally speaking, if I'm going into personal names, I want to understand when am I running out of serviceability. And if I'm going into trust structures, I'm probably more so worried about when am I going to run out of cash. So if I'm going to run out of cash, I start to go back to personal names. And if I'm going to run out of serviceability, I might start looking at trust or company structures if I have the cash available to be able to offset that negative cash flow. Now, one thing you can do is you can put money into an offset account. So this is what I've done in the past is I've actually bought properties in a trust, and then I have an interest-only loan, and I have an offset account, and I run cash in that offset account so that trust can be met by its own commitments, and then I can get a letter from my accountant. Now, all of these loopholes are getting closed slowly and it is getting tough. So again, you do not want to be going into those strategies thinking that you're going to override your serviceability issues massively. You probably could, maybe get an extra one property, maybe an extra two properties, but you know, the old strategy of buying in the right entity, yes, is one thing, personal names, trust, company structure, but the next thing would be tearing down banks, right? So, am I with the right bank to begin with, maxing myself out with that bank, and then going to the next bank and tearing from level one to level two to level three tier banks so that I can prolong my serviceability that way as well? Somebody that's building a $3 million property portfolio but only owns like $150,000 a year, I'd say that you've done pretty damn well to be able to get that far. And if you do want to continually increase and get to 5 million, 10 million, $15 million in property, well, you probably should be trying to increase your income massively so that you can afford to have that $5 or $10 million portfolio. If not, you're still going to get there. You're just going to take a lot longer to get there because you're going to have the engine, which is your income, be a lot slower to transfer into your property portfolio or passive style. So always focus on your income if you can. Explore your structures and see what suits you. But don't just go, and this is the same thing, right? With company structures, for example, a lot of people saying, oh, well, I'm just going to go in a company structure. I'm going to only pay 30% maybe on the way out of this in taxes. But what I would say to that is, well, it depends on what you're trying to achieve, right? Because like if you're trying to buy a property and you put it in a company structure and there's all these setup costs and running costs and the property's not positive anyway because you didn't put enough deposit down. And then all of a sudden you want to sell the property in 5 or 10 years and the goal of that property was to help pay off your home. Well, the time that you sell the property in the company structure, yes, you pay your profit tax, but you're going to have to get the money out of the company and pay top up tax. So therefore, it really wasn't trapped at the profit level. It was trapped at the personal income tax when it got taken out of that to be able to pay off your own home. So therefore, you got to understand what's the outcome. Whereas a company structure could work when you have your own home and it's paid off, right? And then all of a sudden you're just staying in within investment environment. So if you're buying and selling property, you could be doing it within that one company and keeping it at a profit tax percentage, 25, 30% versus, getting top up tax because you're trying to pull it out and personally pay for things like your owner occupied property. So a few things to think about there. Another one, if you have a trust structure, should you look at restructuring with these tax changes? Again, I would go to an accountant with that. I don't think you'd be reactive. Don't be too reactive because what you see now could change in 12 months. Who knows? We might see in the next election that they start rallying that they want, two properties to be negatively geared in your personal name again, and then everyone's stuck in company structures and they really weren't in a company structure for the right reasons. This is why I say you got to be careful that you're not doing it just from a tax perspective because something's changed that could be temporary. It may end up changing back, right? So, for example, this is a clean example of this. A year or two ago, everyone was buying in trust structures because they were trying to exclude the entities to get better borrowing capacity, right? Then the banks caught on to that and started shutting it down. And Macquarie was one of the best banks to do it with. You could actually write your own letter and you could say, this entity meets its own commitments. Off you go, and we can now exclude that entity and go buy more property. However, that got shut down, and Macquarie turned around and said, no, we're not going to do it anymore. Then we had other banks starting to say, well, we will only allow you to borrow up to 70% within that trust structure. So, therefore, you actually had a lot more limits in the trust structure versus personal names. Then we had negative gearing disappear, right? Obviously, negative gearing disappeared against personal names. Now, if a year or two ago those people put it in their personal names, they could have been grandfathered, kept the negative gearing, offset their own income, not had any issues with LVR issues within a trust, and they would have been in a much better position. And a lot of those people that went into trusts can't exclude them anyway, and they can't genuinely exclude them. And now with the tougher rules, it's gotten even harder for them to exclude those entities. So now they're stuck in an entity they can't exclude. It's costing them more money every year to hold the property. They're not getting the negative gearing benefits that were grandfathered for the personal name. And they've actually really royally screwed themselves compared to what they should have done, which was buying their personal names and kept it simple. The one thing that I have been very successful at is keeping life very simple, keeping my structures very simple, buying property very simple, my strategy very simple. And I feel like the more simple you get, people want to know the secrets, but it's like the simpler you keep it, the more wealth you'll create as long as you stick at it and you commit yourself to the time frames to be able to achieve the wealth. The wealth doesn't come from being so clever that you're getting around every single tax rule. The wealth really comes from being simplistic and having a lot of time behind you and being committed to executing on your goals of building wealth, right? Most people don't make it because they're always looking for the next best thing. And then once that next best thing gets shut down, they're like, oh, on to the next one. And then they're sort of jumping from left to right, but they're not really committing to anything. They're just trying to get rich really quickly. And I would say you don't want to get rich quick, you want to get rich for sure. So you do have to be careful how you're playing the wealth game, right? Next one, once you've paid off your principal place of residence, would you pay off investment properties via offset? Or would you invest the money? I would invest the money. Again, depends on your strategy, right? If you've paid off your own home, the next freedom strategy, I talk about the Freedom Accelerator Plan, right? Our program that we do. The next one is we need to build a net worth outside of your own home large enough that eventually we can transition into cash flow. So if you haven't built that net worth large enough, then at that stage, I would say that you need to continually invest. Why would you put money in an offset account when you haven't reached your goals? You need to keep on leveraging to be able to get to your goals. But keep the money in the offset accounts, enough of that money to have an emergency fund against the property portfolio that you're building. That's what I would be doing. And it's not until you hit your goals of I can transfer my net worth into cash flow that's when I would start to do what you're saying, which is, stack money in offset accounts. The money in the offset accounts is there to protect the wealth that you're building, essentially. Next one, at what point do you transition from residential property to commercial property? So I would say you do not transition from residential to commercial until you've achieved financial freedom stage 1 and financial freedom stage 2. Commercial property doesn't come until you are ready for financial freedom stage 3. The reason for that is commercial can be riskier. At high leverage, especially today, it's still negatively geared. It's not like it's positive anyway. It's harder to leverage upon leverage in commercial because if you've got a riskier asset and then you're trying to leverage from that property to the next property and another riskier asset, you can see the domino effect, right? Especially if you're playing at 105% LVR every single time you buy into the commercial. So that's one thing. The next thing is you're going to need larger deposits, typically minimum 20%, more so 30 or 40% for most people is what you would need. So therefore, because it's such cash heavy, you're going to not get as far in terms of being able to leverage. The real returns of building your net worth comes from the higher leverage point that you can have in residential. Now, if you're not going to get cash flow being 105% in commercial, why are you buying commercial when you can get better cash on cash returns in resi? And then once you've achieved your financial freedom stage two, which is I finally have a net worth large enough that if I was to cash out of my residential portfolio, I would have $2 or $3 million sitting in the bank. That's when you will start to transition it to your commercial. The commercial return you get that you really want is the cash on cash return. For example, if I'm buying a $2 million commercial building and I'm getting a 5 or 6% return and I buy that in cash, the return I'm getting is on the actual cash that I put down on that property, right? So that's where it really comes into its own. And that's when you start to go, well, I no longer need massive cash on cash returns. Because when you're buying in resi and you're buying 90% LVRs, when you do that, the capital growth can be like 30 or 40% cash on cash return based on the initial cash that you put into the deal. Whereas when you're trying to get just a 5 or 6% return, it's actually quite low. So people look at it and go, I want this commercial return of 5 or 6%. What they're not realizing is when you've got a debt behind it and the interest on that debt is 6%, the cash flow is zero or negative, right? So therefore, why do I want that asset? What is the goal of the asset? The goal is I need more capital growth to pay it off so that I can actually get the true return of the 6%. So that's why I say focus on net worth. Net worth solves all problems. You want to pay your house off? Net worth. If you want to get cash flow and retire on passive income, net worth. You're not going to do it any other way. You can't just keep borrowing money forever and expect to have a passive income in the end. You have to work out how to build your net worth to be able to transition it into the cash flow side in the end. All right, so next question is how long until prices push back up higher anyway with cost of construction so high? So you got cyclical events and you got secular events, right? So cyclical events are confidence, right? They're quite short cyclical within a secular trend. So when you look at secular trend, we've been in probably a 40-year bull run in property from a secular trend, meaning that there's been dips in the market throughout the 40 years. However, the trend remains higher than lower each decade, and we see that the trend continues up. However, as we have the trend going up, we still have cyclical events where we see the market going up and down, and that can come from, change of policy. It can come from, confidence getting knocked out of the market. It can come from war. It can come from many different angles. Cyclical events, you've got to get used to and understand that the cyclical event is a short-term metric that generally doesn't last longer than 2 years. And I would say in most cases doesn't last longer than 6 to 12 months. So in bad cyclical events, you're probably looking at a 2 year window. In, good cyclical events, you're looking at maybe 6 to 12 months. So what I would say is we're in a cyclical event right now, and the secular trend will probably come once we see that the cyclical event that we're having, which is, interest rates have pushed higher because of inflation, the government has changed policies, and people are just sort of fearful, there's fear of recession and that type of thing. What we will see is people think that that is the secular trend changing. However, it's more so just the cyclical event. And because we're in it every day, we think the cyclical event is larger than the secular trend. If you zoom out, the secular trend is still intact. And why is the secular trend still intact? Well, it's still intact because we're still using the same money system over the long term, which is we continually have to devalue the dollar. Now, we talk about inflation, and inflation's been, high. So what happens is even if the cyclical event happens where prices stayed flat for 2 years, if inflation still remained high, the outcome eventually means that we cannot build houses for the same price as we did years ago. Therefore, the prices eventually have to rise as long as we have the demand for it. And the demand is population. So if we look at Australia, immigration is really, really high and population growth is really, really high. So if we have population growth really strong, but we're not building enough houses and the houses are getting more expensive to build, we can see that that is the secular trend that's still happening and nothing's changed from a secular data point, right? So then you look at the other side of it, which is, are we devaluing the dollar by expanding the money supply? And the answer is yes. The government keeps spending like drunken sailors. They keep expanding the money supply, right? So if the money supply over the long term, now there's events where liquidity pulls out of the market. But over the long term, if we continue to live off a debt society, which is we continue to spend more money than we produce, then we're going to see devaluation in the dollar. And property prices do not go up in value. They are realized value against the devaluation of money. So what happens is people go, well, what's that house worth today versus 5 years from now? Well, it depends on how much the dollar drops and how many more dollars I'm going to need to be able to buy that property. So the mechanisms haven't changed. The short, medium, long term haven't changed, but cyclical events are at play. I would say that middle of next year is probably when we're going to start to see a pickup in the market again. And the reason for that is we're going to see the markets start to get more confident. I think that the governments will start to talk more positive because as they go closer towards elections, they're going to start having to produce their case on what they're going to do for the next term if they get into office. So therefore, they're thinking about, okay, well, how can we give more to the people, which is what? Spending more money, which is what? Devaluing the dollar, which is what? Putting prices of property higher. So therefore, they're like, well, how do we give more money to the people? Therefore, if they do that, the long term of it is the property prices go up. But the other side of it is when they start talking about it, that's the cyclical event, which is they're bringing up the confidence, right? So if they start bringing up the confidence, that's going to make more people want to jump into the market. Now, I do think, though, for that, in all of this to happen, for interest rates to start to maybe drop a little bit, for it's got to get much worse, right? So like we're going to have most people feel like, doomsday. We're going to have to see the media get into more doom and gloom. You can't prosper out the other side of a cyclical event without doomsday. And the reason for that is we have to see things get so bad that the government has to come in and catch the market to push it up again, right? Remember, it's not in the best interest of the government for the housing market to go down long term, right? Now, it can go down short term, 6 months, 12 months, 18 months, right? But in the long term, you can't have a spiraling downturn. And the reason for that is because if you have a downturn, less people spend money, the unemployment goes up, the velocity of money slows. And what happens when the velocity of money slows? Less taxes and revenue. There's less revenue. So you've got to think about this. The government is a business, right? And if the people start to do less, then what happens is the government gets less. However, that becomes a spiral downwards. And therefore, the only way for the government to catch it is to spend more money that it does not have because the people aren't producing enough. But the government needs to spend more money to be able to give to the people to feel confident again. So you don't want to spiral deflation. You want to actually see inflation sort of taper off without having massive unemployment spikes. But I do think that, that for interest rates to drop next time round, we're going to have unemployment start to rise. So watch out for GDP start to turn maybe negative or very sluggish. Wait for unemployment rates to start to rise. And that's when you'll start to see the RBA shit their pants. Because deflation is more scary than inflation because inflation wipes out the government's debt, right? Okay, it wipes out the middle class. We get that. But the government are happy to sacrifice the middle class to make sure that they devalue their debts. Because if they're devaluing their debts, guess what they get to do? Spend more money, right? So they're okay with inflation. But when you see deflation, that's the opposite effect. Now, all of a sudden, the government can't spend more money because there's not more money coming in and they're not devaluing the debt that they've already got. So therefore, it becomes a lot harder to run the same debt scheme. We aren't running off a society of savings. We're running off a society of debt. Our debts are larger than our assets, and therefore we have to keep exploding the deficit because there's no other way. And that in itself, exploding the deficit, expanding the money supply through debt, actually creates growth, right? It's creating the GDP to increase and it's making the numbers look fudged. So Anyway, this is more of a longer tangent, but that's sort of what I would see. And again, not all markets are doing the same thing. Don't think of the market as going down or going up, right? The luxury market's coming down, the middle end of markets coming down, the lower end of the market's going up. So therefore, you've got to find those markets and find the right strategy now. I would say the lower end of the market, sub $1 million, and then finding the right market to be in is the sensible play versus buying the blue chip asset, thinking that's the play. Um, I'll do one last question. Build on a block to negatively gear or buy established. Okay, so this is how I would analyze that. If I'm going to build a brand new property, I want to go analyze like for like. I want to analyze the land size and the house internals, how big the house is, how big the bedrooms are, living spaces, and everything like that. Then I want to go find the established property and do the exact same thing. Is the established property cheaper, and how much by? What I found in the past is I could go buy a brand new property, for example, for a 1.1 million, but I could buy the existing property. It's a little bit tired, but I could probably buy it for 750,000. Well, if that's the case, why am I buying a brand new property if the existing property is 750K when the brand new property is 1.1 million? There's a reason why the government says we will give you depreciation on a brand new property because the house depreciates, right? So I want to buy the house that's fully depreciated and increase its value. If I buy the established property that is cheaper and I do a renovation, I actually increase the value for doing that. If I buy a brand new property, there's nothing more I can do to that property. It's now just depreciating, and you're hoping that the market's going to catch it for it to keep going up. Now, one thing that has fooled a lot of people with brand new is because the inflation has been high, the construction costs have been high, they've actually mitigated the depreciation on the new builds for the last 5, 6 years, which normally isn't the case because the construction costs keep going up. So therefore, it's actually made new builds look okay. However, in downturns and when we see the other side of this, where inflation starts to taper off and deflation becomes more of a headwind in the next, say, 10 years, what you'll probably find is those new builds will go back to its original value, which is depreciating, and therefore you won't get as much growth out of them. But look at it like for like. If I'm buying the brand new property and the established property at a 2 or 300 grand difference, is the negative gearing worth paying 2 or 300 grand more to begin with? Or should I be buying the established property, which is 2 to 300 grand cheaper? And also, if we look at the total numbers, when I sell out of the established property, the negative gearing losses that you're talking about with the brand new property, you still get with the established property. You still get it. It comes off the capital gains tax. So if we looked at a property over a 10-year period and we sold the properties, the cheaper property does better because I saved 2 to 300 grand to begin with on the brand new one, which means I could probably buy more property because I can get into more debt and buy more property. But also, when I take off all the losses on the early days of owning that property, I actually become wealthier from buying the established property, and I can build a larger property portfolio because I've carried less debt, even in the same area. Why carry an extra two, three, $400,000 worth of debt the same area to get access to the negative gearing? And then also, I would be looking at the area as well. If you're buying a rental stock property, like the property that's in an area that's more rental stock, just remember the next person that goes to buy it won't get negative gearing, so they won't want your property. So therefore, you've got less people wanting your property. You're also going to have probably less rental growth because you've got a brand new property, and all the investors that were stupid all thought, yeah, let's go buy these properties. They all lined up and they all looked at each other and went, oh, we're all bought investment properties that are brand new next door to each other. Oh, there's not as much rental demand out here. Oh, okay. The established property market, where you went into a nice established market, there's not as much rentals. Those rents have been growing because there's not new stock coming to the market and you were buying more owner occupier. So, again, make sure that you do the numbers on it. Do not buy a property based on negative gearing. You still get it with existing properties, and do not buy it on tax incentives because they can change. We've seen that. Be very, very careful. You're trying to buy a property to get capital growth. You're not trying to save 30 cents in the dollar. Remember, negative gearing is that you spend $1 and save 30 cents, right? You save your marginal rate of tax. So do it wisely, smart. Get a strategy in place, understand why you're buying property. Don't just buy property, understand why you're buying property. Anyway, guys, this is another episode of Anchored in Property Podcast. This is a Q&A. Hope you guys got a lot of value out of it. And until next time, guys, bye for now.